Welcome to the Explainer. So, let's talk about AI. The hype is absolutely massive, right? And today, we're going to dig into the one question that's on every investor's mind. And honestly, it should probably be on yours too. All right, let's just get right into it. This is the big dilemma, isn't it? The excitement is totally electric, but you can feel the anxiety bubbling under the surface. Are we just watching a replay of some classic financial mania where, fortunes get wiped out? Or is this time for real? Is AI actually the foundation for a whole new economy? So, to really get a handle on what's happening now, we've got to rewind the clock a bit. The last time a new technology promised to change, well, absolutely everything, it didn't end well for a lot of people. It actually led to one of the most infamous market blowups in modern history.
I mean, look at this. The story it's almost identical. It's kind of spooky, really. You've got this powerful, viral story about a world-changing technology that's just capturing everyone's imagination and pulling in massive, massive amounts of money. Sound familiar? Back then, you just had to have .com in your name and your stock would soar. Today, you just whisper the letters AI and boom, you get a huge boost.
And if you really want to understand the stakes here, you just need to think about one number: $5 trillion. That's the estimated value that just, poof, evaporated when the dot-com bubble burst. It's a really painful reminder of what happens when hype gets way, way ahead of reality.
Okay, so is history just repeating itself? Are we doing it all over again? Well, let's look at the data, because honestly, some of the key indicators out there are flashing bright red. They're basically screaming that the market is in a super risky, super fragile state right now.
So, the first giant red flag? It's something called market concentration. Get this. Right now, the top 10% of stocks in the U.S. market, they make up a staggering 76% of the entire market's value. I mean, just let that sink in for a second. A tiny handful of companies are driving pretty much everything.
And here's where it gets really wild when you put it in historical context. This level of concentration, it's higher than at any other point in modern history. We're talking higher than even the absolute peak of the dot-com bubble. And what does that mean? It means there's no diversification. The entire market is basically riding on the performance of just a few giant tech stocks. That's a pretty precarious place to be. And it's not just that. On top of all that concentration, the market as a whole is just incredibly expensive. So statistically, what we're seeing is a 3 standard deviation event. Now, what does that mean? It's something that should almost never, ever happen. It's a total statistical outlier. It means investors are paying a price for stocks that's historically off the charts, betting that future growth is just going to be, well, astronomical. But if you want the real kicker, the clearest sign that we're in some kind of speculative frenzy, look at this. The stocks of tech companies that aren't even making a profit, zero profit, have skyrocketed 66% since April. That's more than double the already amazing run of the S&P 500. When companies that don't make any money are leading the charge, that's a classic textbook signal that pure FOMO, fear of missing out, has taken over.
Okay, but the story has another layer. It's a little more complicated than just stock prices. See, a bubble becomes really, really dangerous when there's a lot of borrowed money, leverage fueling the fire. And the fuel for this AI boom? Well, it's coming from a different and much more hidden place. Let's talk about something called private credit. You might not have heard of it, but it's a massive multi-trillion-dollar market that pretty much operates in the shadows, outside of the normal banking system. You can almost think of it like a parallel financial world, and it has been growing at a crazy pace, just pouring money into things like AI.
And here's where the risk really comes in. This is the scary part. These private funds, they're not just using their investors' money. No, they're borrowing heavily from the traditional banks we all know to juice up their bets. And that creates this hidden connection. So if these super high-risk AI bets go south, the losses don't just stay in that shadow market. They could come crashing right back into the core banking system that we all depend on.
I mean, the growth here has been nothing short of explosive. You look back a decade ago, this was just some tiny niche corner of the finance world. Nobody really talked about it. Today, it's a major, major player. It's deeply woven into the traditional financial system, and yeah, it's funding a huge chunk of this AI revolution.
So we've got these totally conflicting signals, right? On one hand, you have this incredible once-in-a-generation opportunity. On the other, you have extreme, flashing red risk. So what are the pros doing? How are they playing this? Let's take a look at what the big fund managers are actually doing with their money.
Well, surprise, surprise. They're completely split. It's pretty much a 50-50 call. A slim majority thinks, no, we're not in a bubble yet. But a really big and growing group is saying, yes, absolutely we are. The takeaway here? There is zero consensus on Wall Street. Just deep, deep division.
So the really crucial thing to look at is what they're doing, not just what they're saying. And while nobody wants to miss out on the big AI party, they are absolutely getting ready for things to go sideways. Almost half of them own gold. That's your classic safe haven play. A growing number are starting to dip their toes into crypto. And get this, they're making massive bets that smaller, weaker companies are going to fail. That's a huge sign that they're pretty pessimistic about the broader economy.
And this chart really tells the story, doesn't it? Look at gold, the ancient, trusted store of value. It makes up about 2.2% of these big institutional portfolios. Now look at crypto, the new kid on the block. It's just 0.3%. That's a massive difference. It shows you that gold is already an established hedge, right? But institutional money in crypto, it's just getting started. That suggests there's still huge potential for growth there as a portfolio diversifier.
All right, but let's just zoom all the way out for a second. What if this whole debate about a stock market bubble is, well, kind of missing the bigger picture? What if the real story here is a fundamental, ground-up reset of our entire economic system?
I mean, this is a really profound, almost philosophical idea. What if the biggest impact of AI isn't just that it makes us more productive? What if it makes human labor itself obsolete? Seriously, think about it. If AI can do everything, what happens to jobs? What happens to wages? What happens to the very foundation of capitalism, which is basically built on us trading our time and our work for money?
And this one statistic just puts everything into sharp focus, doesn't it? Just 4% of what the world spends on its militaries every year could completely end world hunger. Now, in a world where AI could potentially create unbelievable abundance, our current priorities just seem kind of off, right? And look, this isn't a political point, it's an economic one. It's about what we, as a society, actually value.
So, as we wrap this up, the real takeaway isn't just about whether you should buy or sell some AI stock. It's much bigger than that. AI is forcing us, all of us, to look at a future where the basic economic rules we've lived by for centuries just might not apply anymore. Maybe the real bubble isn't in the stock market. Maybe the bubble is in our old ideas about what human work is even worth. And that is a question really worth thinking about.